Have you been forced into stocks and other asset classes because Treasury yields are sitting near all-time lows? If so, I'm going to show you a strategy that you can use to help identify better opportunities to park your money while we wait for higher yields in Treasuries and other bond classes. On the chart, you'll see a 5-year Treasury note yield, and generally the trend has been going down since the 90s on here, but in reality since the early 80s, when interest rates were peaking in the 20% range. In the 2012, this rate hit as low as 0.5%, and has since gotten a rally back up towards the 2% range. But generally, the last 5 years, the 5-year yield has been under 2%. Thanks for joining me today. This is Chad Karnes, Chief Market Strategist at ETFguide.com. The search for yield has sent many investors looking for dividends, for real estate, for other alternative asset classes to provide some sort of income while they're getting historically low rates on money markets, cash, and safer bond classes. This search for yield has been kind of classified by the media as TINA, which is an acronym for there is no alternative. But I'm going to show you a way that I think you can beat TINA, that I think you can find value in certain areas using what's called in technical analysis relative strength. So the first chart I want to show you is of the Consumer Discretionary Sector ETF, which is XLY. And this is a 6-year chart, 7-year chart, and you can see that XLY has made new all-time highs and has just been on a roll for the last 5 years, peaking out at around $65. Now, some of this reason is because people have even been looking for yield in some of the lesser dividend yielding stocks, such as some of the retailers that provide 1 to 2% of yield. But there's something wrong with this strategy, as it's taken prices now and valuations up well into the 20 multiples on many of these companies at essentially historically all-time high multiples. So what do you do? Well, first of all, I want to show you how extreme this has been in this search for yield. So this is the same XLY, Consumer Discretionary, but not priced in dollars. Instead, it's priced in bond prices. So this is the XLY divided by the 5-year bond price. And this too can show you that, yeah, bonds are at all-time low yields, which means that they're at all-time high prices, but stocks such as Consumer Discretionary are at even more all-time high prices, essentially showing you that they're overvalued significantly more than they were back at the 2007 top, and especially back at the 2000 top. This chart shows you that if bond yields start to rise again and become more attractive, that there's a lot of downside risk in consumer discretionary stocks that are now over 2 times their average price compared to bonds. This implies, compared to bonds, that there could be a 50% fall in consumer discretionary, or put another way, perhaps a 25% fall in consumer discretionary stocks and a 25% rise in the 5-year bond yield. But even more so, how do you choose between individual stocks and or sectors? Well, this is a chart I included in our December ETF Profit Strategy Newsletter back in November, showing comparing the consumer staples with the consumer discretionary ETFs. And you'll see a few things here. Obviously, the valuations fluctuate through time. Going back to the year 2000, generally the staples were a lot less expensive up into the 2000 top than the consumer discretionary stocks were. But during the recession then, consumer staples outperformed the discretionary. During the rally up until the 2007 top, discretionary outperformed staples, and you got this back down to this area of about 0.6 to 0.7 times the price of the consumer discretionary stocks. Then throughout the 2009 financial crisis, you had a rush into safety, so there's a lot of buying of the consumer staple stocks that sent this ratio up into extreme areas. But now you see you've got this back down into this area where historically the consumer staples are cheap compared to the consumer discretionary stocks. I think buying consumer discretionary stocks right now is not a smart thing to do. I think you should be putting your money in consumer staples and other safer assets like bonds and whatnot. And I think these relative strength charts that I just took you through support that thesis. Thanks for joining me today, and please check out some of our other videos at ETFguide.com, including a couple I did using technical and sentiment analysis on Apple, and then another video on our recent profitable gold trade and how we were getting long gold back at the beginning of 2014 when most everyone else was bearish. We're also on Twitter at ETFguide, and we publish a monthly newsletter, weekly ETF picks, and I do a twice weekly technical forecast for our subscribers on our site at etfguide.com.